So we are looking at stock exchange or investment ratios. They call them stock exchange or investment ratios for a reason. These are the common ratios that are used most of the times when you are analyzing performance of shares or stock on a stock exchange, okay, or those stocks that are listed on the stock exchange. So they are more or less at times used for valuation purposes. As you go up the ladder of knowledge, you start to learn about some multiples or price to book ratios that are then used for valuation purposes. But basically, the ratios that we're going to learn today, you will continue using them up until even when you get into practice, you'll be using them as well. So I'm going to list down the ratios and their formulas as well. So we'll start with earnings per share. Earnings per share, the formula is your net profit less preference shares, dividend, net profit less your preference share dividend, which means the amount of money or the amount of profits that you now have after distributing to preference shareholders their dividend is the amount of money that is now available to your ordinary shareholders. Okay, so that is your net profit less less preference share dividend. So this is now the amount of money that is available to ordinary shareholders. Remember, ordinary shareholders are the last people to get their dividend. Preference shareholders get that preference. And you divide it by the number of issued ordinary shares. Divided by the number of issued ordinary shares. Please notice issued ordinary shares, not authorized ordinary shares, the issued, those shares that were issued. Okay, so you don't use the authorized shares at times that are there in the statement of financial position. You only divide your profits that are readily distributable to ordinary shareholders. You divide it by the number of issued ordinary shares. Remember, this is not a value. You're not dividing it by the value of your issued ordinary shares, but by the number of issued ordinary shares. So at times the question might come with a value and the share price, and it won't have given you the number of ordinary shares. So you definitely need to compute that by dividing the value by the price per individual share for you to get the number of issued ordinary shares. So that's usually the trick that's there, and that's where most students make mistakes. I'll explain it later. Let's go to price earnings ratio. So price earnings ratio, this is simply saying you have to look at your share price. When you look at your share price, the price of the share at the market currently, or the market price of the share, you divide that by your earnings per share to get your price earnings ratio. So you have to, usually you are given, this figure is usually given. You are told what the market price of a share is on the stock exchange. You are told what the market price is. So you divide that by your earnings per share, the one you have calculated on top. So it's usually a function of that first ratio that we calculated. So market price per share, but that is the price in which it is currently trading at on the market, divided by earnings per share. It's usually abbreviated as EPS. Okay. And then we go to the next ratio, which is the dividend yield. Remember, we said when ordinary or when shareholders invest in a company by providing share capital, they expect a return on the capital that they invested in the business. And that return can come in the form of a dividend. Okay. So we can also calculate the yield, the dividend yield, which is your dividend divided by the market price of the share. So when we look at the dividend, we are saying you include both the paid and the proposed. So you're saying your dividend, both paid and proposed, divided by the market price of the share. And we go on to the next one, which is the dividend cover. For dividend cover, we are simply saying the amount of money that is available, the amount of profits that is available to ordinary shareholders divided by the ordinary dividend that we paid for us to get the dividend cover. So it's profit available to pay ordinary dividend, which is literally your net profit less preference share dividend. Okay. That's your profit available to pay ordinary dividend.
Same.
Yes.
And dividend yield. Let's say we have both proposed and paid. We are supposed to add, then divide by the market price of shares.
Correct.
Okay. Thank you.
The profit available to ordinary shareholders. And we said the profit that is available to ordinary shareholders is your net profit less your preference dividend. So that is the profit that is available to ordinary shareholders. And you divide that by your ordinary dividend paid. And then last but not least, we have the dividend per share. We are going to say the ordinary dividend that was paid divided by the number of issued ordinary shares. I think that's straightforward. Divided by a number of issued ordinary shares. So usually these are the ratios that you will most likely be focusing on for stock exchange ratios or investment ratios. So far, so good, correct?
Yes, sir.
Okay.
Okay. Thank you.
Okay, so we can try and look at when we look at the price earnings ratio. What we can literally do is to say, so I'll try and explain these ratios so that they try and make a bit more sense. So let's look at which one can be more interesting. Price earnings ratio. Price earnings ratio. We said we are looking at the price per share divided by the earnings per share. So in literal sense here, if we look at it at face value, we are saying that a share will have a price that market participants are willing to buy and sell it, okay, at a given moment in time. All right. So let's say a share of a certain company, let's say Delta, let's say it's at $100 per share. That is the price in which has been determined by the forces of supply and demand on the stock exchange. That is what the market is willing to trade the delta share price at. Correct. And then at the same time, we know how much we are going to be earning from that share. That is our earnings per share. We know how much we are going to be getting for each, or the return we are going to be getting for each individual share. So literally, if we are dividing the market price by the earning or what we are going to be getting from that share, we can literally know how long our return is going to be. How long will it take us to recoup our, let's say, initial investment? Okay, if you bought a share for Delta for $100, all right, per share, that's what you bought it for. And it is giving you an earnings per share of, let's say, 50. What it will literally mean is that it will take you 2 years to recoup your initial investment. It will take you 2 years to break even and start to earn a profit, literally. Okay, so usually people say that usually people are just trying to say that the price earnings ratio, it just represents the number of years earnings that investors are prepared to pay to purchase one of the company's shares. So the higher the PE ratio, or price earnings ratio, the greater the confidence investors have in the future of the company. Okay. So a high price earnings ratio just indicates that the expected future growth, investors are expecting a growth in the future of the share, or literally an overvalued share. All right. A low price earnings ratio indicates poor performance or expected poor performance in the future, or an undervalued share. So I think I'll probably have to write that down. It represents the number of years earnings that investors are prepared to pay to purchase one of the company's shares. Okay, so we said that a high PE ratio indicates expected future growth. So we can say a high price earnings ratio indicates expected future growth. Okay, or an overvalued share. The share is overvalued. what the market price is and what you are earning for it. Okay, if what you are earning from the share is less than what the market price is, it will result in a high price earnings ratio, which literally means that that stock is overvalued. Okay, if we have a low price earnings ratio, it indicates what? It indicates expected poor performance in the future. Expected poor performance in the future, meaning that, again, this is an undervalued share. The share is undervalued. This one means the share is overvalued. Make sense? Okay. We go on to what? The dividend yield. Okay. So you should notice that shareholders invest in a company in order to gain a return or dividends in their investments, as I said to earlier. All right. And they also probably get to make a capital profit through capital gain. But we don't care about that. So we are saying, let's just focus on this for now. Shareholders invest in a company in order for them to get returns. The returns come through dividends. So the dividend yield expresses the actual dividend received by a shareholder as a percentage of the market price of the share. Okay, so it shows the actual percentage return an investor can expect based on the current market price of the share. So it's simply expressing your actual dividend received by the shareholder as a percentage of the market price of the share. There is another version of the formula for dividend yield, which might come in handy. So let's just say, or you can say, let's say the declared rate of dividend times the nominal value of ordinary shares, nominal value of ordinary shares all over the market price of ordinary shares. let me do this. Market value of ordinary shares all over the market price of ordinary shares. So you're saying your declared rate of dividend. At times you might be given a declared rate of dividend. You might have the nominal value of ordinary shares and the market price of ordinary shares. You can use that to calculate your dividend yield. So this first formula won't be applying because in the question you'll be given the rate of the dividend and the nominal value of the shares and the market price of the shares. So that is what you use to calculate your dividend yield, which we just said is your dividend expressed as a percentage of the market price of the share. Then we go to your dividend cover. A dividend cover, well, let's just say it indicates how likely a company can continue to pay its current rate of dividend. It indicates how likely a company may continue to pay its current rate of dividend in the future. Here, I mean ordinary dividend, okay? Ordinary dividends in the future. So for dividend cover, a high figure is good because it suggests that the company should be able to maintain dividends to ordinary shareholders at the current level of profits, even if the profits fall. It can also indicate that the directors operate a conservative dividend policy, that much of the profits are actually being reinvested into the company and they're not being paid as dividends to ordinary shareholders. So a high figure is good. A low dividend cover indicates a reckless dividend policy, and that a small reduction in the company's profits may have an adverse effect on the dividends in the future. So we're saying a high dividend cover is good. There's no definition of what's high, what's low. Okay, but then that's when you start to compare with industry peers. What are the companies in the same industry? What are their dividend covers like? So that's when you can now get a sense of whether it's high or low, or also look at the history, okay, and probably perform a trend analysis. You'll be able to know if the dividend cover is high or low, either based on past performance of the business or based on an analysis of industry peers or what companies in the same industry of the business, how they are performing in terms of dividend cover. That's when you'll be able to know if the dividend cover is high or it is low. It's based on comparison. So a high figure is good because it suggests that the company is able to maintain its dividend to ordinary shareholders at the current level, or even if profits fall. So if profits fall, there's not much worry, because already the dividend cover is high, and it tells us that the company is able to pay us dividends. Okay, so that's a good sign. That's a good thing. It also tells us that the company also has, or the directors operate a conservative dividend policy, and that much of the profits are being reinvested in the company. So it signals a high dividend cover, signals a high or conservative dividend policy. Where will I write that? A high dividend cover signals a conservative dividend policy. A low dividend cover signals a reckless dividend policy. And we said that with a high dividend cover, the company will be able to maintain dividends to ordinary shareholders at the current level, or even lower. So I guess that those are some of the key cues you need to know. Dividend per share, we're just saying this indicates how much dividend was paid for each ordinary share held. Okay. So what else is left? We now have dividend yield, price earnings ratio, earnings per share. So for earnings per share, we are simply stating that. So we say that this is the amount of profits that are available to ordinary shareholders, and then you divide that by the number of shares that were issued. So this usually serves as an indicator of a company's profitability. And it's usually seen as a fundamental ratio. So I think at face value, this earnings per share ratio will tell you how much a company makes. It tells you how much a company makes for each share, for each individual share that it has. All right. So it tells you how much you will be earning for, per each individual share. It's like your return. How much are you getting for each individual share that you bought or you are holding? I don't know if it makes sense. So usually a higher earnings per share indicates greater value because investors will pay more for a company's share if they think that the company has higher profits relative to its share price. Okay, so we're just saying usually a higher earnings per share just indicates that greater value because investors will probably pay more for company's share if they think that the company has probably higher profits relative to its share price. Okay, so higher earnings per share indicates high value. For some people see the profitability ratio. Okay, interesting. I think we're done. I think we're done. Anything that is left? Let me see. Yes, I think we're done. I think we can try and attempt this question. Quite easy. And we should be done in no time since we have the ratios. Most of them, we did them. Only this one, interest cover. So we told that Kane and Abel prepare a budgeted income statement for the company. Kane and Abel want to know if their investment in Kane and Abel Limited will be worthwhile. So these guys are actually investors. So they prepare a forecast profit and loss account for the company for the first year to 31 October 2008, in which they propose to issue some preference shares. The ordinary share capital will not be altered during the year. So we are given a forecasted profit and loss account for the year 31 October 2008. So that's your income statement. You're given your operating profit, your interest payable, profit before tax of 48, taxation of 12, profit after tax of 36, transfer to general reserves, preference dividend, ordinary dividend, and then your retained profit for the year, which is 6,000. And then we were told that they were able to calculate some investment ratios from the budgeted statement. The projected share price at 31 October 2008 is $1.80. Remember when I said that they usually give you the share price is $1.80. Calculate the following ratios. Interest cover. So let's do what we are told. A, interest cover. Interest cover, how do you calculate interest cover? Had you read it before? Millicent?
Yes, sir.
Interest cover
I'm not sure, sir.
We'll do it. I thought you guys did this on our level. I think profit before interest and tax. Profit before interest and tax divided by interest payable. For interest expense. So it's simply taking what we are given in the question. What is our profit before interest and tax?
It's before profit before interest and tax is 50,000.
Right. So we say 50 divided by what is our interest expense?
It's 2,000.
So 50,000 divided by 2, we get 25. And because this is an interest, it's a cover. How many times? We present the answer in terms of times. So 25 times. Quite simple, right?
Yes, sir.
And then we go to dividend cover. So this is what we did today. This is where the focus is on. Dividend cover. How do we get our dividend cover? What is the formula?
Profit available to ordinary shareholders divided by dividend paid.
So give us the profit available to ordinary shareholders. What is it? A calculator? Miss, profit available to ordinary shareholders. How do we get that one?
I got 28,000.
How did you get it?
I think it's wrong though. I said 36,000 minus the preference dividend of 8,000.
Okay, so that's correct. Makes sense.
Okay.
It's 36,000 minus, say, 8,000 from the preference dividend. So this is the amount of money that is now available for ordinary shareholders for distribution, divided by what?
Divided by the ordinary dividend paid.
And how much is that?
It's 12,000.
Yeah. What are the advantages?
Correct. And how much, what's the answer that we get? How many times? How many times that does our dividend provide cover? What's the answer?
2,33.
Correct. So it's 2,33 times. 2,33 times. And then we go to C part, earnings per share. How do we get our earnings per share?
Net profit minus preference dividend divided by the number of ordinary shares.
Is it profit before tax or after tax?
It's profit after tax.
Okay. So profit after tax less our preference dividend divided by the number of ordinary shares. Divided by the number of ordinary shares. So I think we did this one already. It's 36,000, 36,000 minus 8,000 divided by what is the number of ordinary shares?
is $1 per $1.80.
$1.80. The number of ordinary shares.
The number of ordinary shares. Okay.
Yeah.
Okay, so I think I also left this one out by mistake, but it's also given as well. It is given, but it's not in this scenario. Okay, it's not in this scenario, so it is 120,000 shares. So issued shares is 120,000. So it's not 120,000. It's not in dollars. It's 120,000. So we can divide by 120,000. And if you say 36 minus 8, we said we get 28. 28 divided by 120, and we get 0.23. That's our earnings per share. Remember, this is the number of ordinary shares issued, eh? You don't take authorized. Okay, after calculating earnings per share, we've got price earnings ratio. Price earnings ratio, we did this. It's your market price per share divided by your earnings per share. So how do we go about this one?
The market price for the shares is $1.80.
Okay.
It's $1.80 each divided by 23 cents.
What do we get?
I don't understand.
What do we get?
I got 7.83.
What 7 point what?
83.
Are you sure?
I think we put earnings per share. Earnings per share, is that a 3 or a 5? It's supposed to be 0.23.
Yes, it's 0.23, yes.
Yes.
So you got what?
I got 7.83.
We can write 7.8 years. Okay. That's how long it would have to be able to recoup the investment in the share had we bought it at the market price. And we go on to E. E requires us to calculate what is it? Is it dividend yield? Yes, dividend yield. Dividend yield. And we said the formula for dividend yield is literally your dividend paid and proposed divided by the market price of the share, correct? Divided by the market price of the share. So how do we go about this one?
It's supposed to be, it's 12,000 divided by $1.08.
12,000 divided by $1.80.
Yes.
If we say $12,000 divided by $1.08, do you notice something? This $1.80 is per share. And this 12,000 is for all the shares, which makes it a bit proper or a bit imbalanced. Okay, so this dividend paid and proposed, if you are going to take the market price, it's either you multiply this $1.80 times 100. We said it's 120,000 shares, right? The number of shares that we have here, we've got 120,000 shares. So you'd either multiply your market price per share of $1.80 multiplied by the total number of shares that you have. So you're now saying 12,000 divided by $1.80 times 120,000. Or you can literally say this 12,000, which is your dividend, you want to find your dividend per share first. Okay, so you're going to say 12,000 divided by the total number of shares for you to get your dividend per share. So divided by 120,000. And you get your dividend per share. And that is what you then divide by the market price per share of $1.80. And you obviously multiply by 100%, all of them here. By 100, here by 100, because you want it as a percentage. Is it making sense?
Yes, sir.
Yeah. So your dividend paid and proposed, you simply get your 12,000. And when you got your 12,000, this is all the dividends that were paid and proposed, 12,000. And you know, you either you want to find the dividend paid and proposed per share. So you divide by the number of issued ordinary shares, and you get the dividend paid and proposed per share. And then that's what you then divide by the market price of the share. Okay. Or you can do it, you can say 12,000 divided by $1.80 times 120,000. So that's the market price of the share times all the shares that were issued by the company. So both methods should give you the same answer. And what answer did you get? What answer did you get?
About 5.56%.
Correct. So we do the last one. If, and on if they want us to calculate the earnings yield. They want us to calculate the earnings yield. And we said that the earnings yield, how do we get our earnings yield? We say earnings per share divided by the market price.
Sir,
Yes.
is there a difference between price? Price earnings ratio and earnings ratio, earnings yield. Sorry.
Yes. Have you noticed the difference?
Yes.
Exactly. They're sort of like inverted. This is an earnings yield. So anything that you see with a yield, you always know that your denominator is the market price. Anything with a yield. So look at our dividend yield. You notice that our denominator for the dividend yield formula is your market price. You notice that? Our earnings yield, the denominator is the market price. So anything with yield, always know that the denominator is the market price. The numerator, we are told by the first sentence or by the first word. Okay, in this case, we are told of earnings yield. We are told of earnings yield. So our numerator, this becomes our numerator, the earnings. So earnings per share divided by the market price. If it's dividend yield, you then know that the first word dividend is our numerator. So it's a dividend divided by what? Your market price. I hope it makes sense.
Yes, sir.
Okay, so here, our earnings per share, we should already know our earnings per share. We calculated them already. And we got how much?
23 cents.
0.23. So we're going to divide that by our market price per share. And what is our market price per share?
$1.80.
Divided by $1.80. And you always know that everything that has a yield, we multiply by 100. So multiplied by 100. So 0.23 divided by 1.8 times 100, what do we get?
12.78%.
12.78%.
Yes.
0.78%. So that becomes our answer, and that is, I guess, the last of it. That is the last of it. So that is how you attempt or answer these ratios. So these are investment ratios. Yes, they are more difficult ratios, but if you get the concept, it becomes a bit more easier. And as in accounting, you should know, you are exposed to the number of questions that you attempt to answer. That's your knowledge is gauged by that. So be rest assured, there are more tons of other ways of or other questions that are probably much more difficult and require a different skill in order for us to get the answer. But you are only as exposed to the number of questions that you practice, especially when it comes to ratios. We definitely can't do all of them in this tutorial. We definitely can't.